Right, welcome to part 3 of lecture 10-A. So we've just completed this first problem looking at how to allocate the cost of a lump sum purchase into, or how to divide it into different categories. Let's look at the next problem we've got here now. JetQuick Airways. They repaired one of their Boeing 767 aircraft for $600,000, which they paid in cash. They erroneously, so they made an error, capitalize this cost as part of the cost of the plane. How will this accounting error affect JetQuick's net income? Okay, so they should have expensed it, right? Because it was a repair. But instead, they capitalized it. So if we have revenue minus expense equals net income, if you take away expense, then net income is going to be bigger. So we can say net income is overstated, so it's too high by $600,000. All right. So let's look now a little bit closer at amortization itself. But let's go back before we do that and take a look at the definition of an asset. So what is an asset? It is an economic resource that is consumed or used, I guess, in the generation of revenue. So this could be investments like a stock that is held for resale, or it could be equipment in a factory, right? Any of those, both of those examples are assets. Now, the resource consumed in the generation of revenue. How is the consumption then reflected? Well, that's where we bring in the concept of amortization, right? And if you remember the American term, depreciation. So Financial Intelligence talks a lot about depreciation. It's an American book, and that's why. So that's the U.S. term for amortization. Okay, so this is basically the gradual expensing of the asset's value over its useful life. Okay, so then what is amortization itself? Well, it's a number of things, and this is kind of important here. First, it is an accounting representation of the consumption of an asset. Okay, an accounting representation, not reality, not a measure of how much the asset has kind of worn out. It is an accounting representation only. Okay. Now, it is also a non-cash expense, right? The cash flow associated with the asset and all this happened when you bought the thing in the first place, right? You paid full price for it when you bought it, and that wasn't an expense. That was capitalized as the cost of an asset, and now you're slowly expensing that purchase price. Okay. Also, it is very importantly to remember, it is an estimate by management, and therefore subject to getting it wrong, right? If you remember back in Financial Intelligence on page 59, they talk about Waste Management Inc. and changing the expected lifespan of their garbage trucks did miraculous things to their financial statements until eventually they had to take a huge write-down because they had, too much or not enough accumulated amortization taken against the assets. So they were cooking their books, basically. So amortization is not a cash-based expense, obviously. It is also not a tool for valuation. Okay, so the book value of an asset, which is purchase price minus accumulated amortization, the book value of an asset has no relationship to the market value of the asset. Book value has no relationship. Now, it can be exactly identical to the market value, but there's no requirement that that actually happen. That would be essentially coincidental if it did, or the asset has been written down to reflect its market value. So just bear in mind, the book value has is not required to have any relationship to the market value of the asset. So how is amortization calculated or measured? Well, using one of three methods. The easiest and most straightforward is called the straight line method. Another one we're going to look at is units of production. And another one is the declining balance or the double declining balance. And we'll explain kind of how each of those works, and we'll get some practice calculating them and taking that all the way into the journal entry stage in lecture 10-B. So in this lecture, we've looked at the cost of property, plant, and equipment. We've looked at the decision around capitalizing versus expensing an asset, and we've talked about the concept of amortization itself. Next lecture will be a detailed discussion of all three types of, or three methods for calculating amortization. And this concludes lecture 10-A.